Hey everyone, this is Alex from mytradersjournal.com. Today I am covering how to use my options tracking spreadsheet for naked puts. I put a link in the description below for where on my blog you can find this free spreadsheet and some other spreadsheets that I'll cover later. This is the one I use most often, so I opted to start with it. I'll run through an overview of the spreadsheet, then I'll show you how I use it based on a look at an ETF chart and an ETF's option table. Okay. So let's dive right in. This is the spreadsheet you'll see when you open it. I'm going to skip column A here to start with, but I'll come back to it in a little bit. Big thing is here in yellow, all of these in columns B through G are the cells that you can manipulate without messing up anything else in the spreadsheet. Everything else has a formula in it. The ones that are colored here, I, L, and M, the columns I, L, and M are the ones I like to use colors just to be able to let my eyes flow to where I want to be a little bit easier. So change it whatever works for you, but that works for me just so my eyes are drawn where I want to. Mostly I could have it, I guess, in a different order, but this is the way I built it and I haven't taken the time to mess with it. It works. Anyway, okay, so stock, current price, strike, premium, number of contracts. This is only relevant for those of you who have a broker who charges an over fee or fee over just the contract fee. I'm with Interactive Brokers, so they only charge per contract compared to somebody like TD Ameritrade that charges a flat fee and on top of each contract trade. So if it's not relevant to you, don't worry about it. If it is, adjust number of contracts as you trade and it'll flood in later in the spreadsheet. So number of weeks expiration. I'm going to skip down and show you how I have that organized just so I don't have to think when I'm running through this a little bit quicker. Down at the bottom here I have the dates. I put it out for the next Friday. Today is January 30th, about midday. So I have in here the date for the next Friday and then the number of weeks till we get there. If this week passed, I would change this to 1 and change this to the next date and oops, excuse me, yeah, and it would update everything as it goes through, but I'm not changing it right now, so I'm going to keep it as it is since this is accurate. So when I'm looking at the options in a little bit, I'll see March expiration is 6 weeks out and April is 11 weeks out. Plus today's a Monday, so 0.9 of a week to go. So you'll see how that floods in a minute as I get to it. So back up here, that's the number of weeks to expiration. The money I need in reserves to avoid a margin call. That's just kind of something. That's one of the first things I learned how to do on here, of making sure I wasn't getting in too deep. But it just multiplies the strike and the number of contracts minus the profit. So pretty straightforward. Just making sure I have the money available when I need it. Cost of exercise, pretty basic also. It's the strike where I have to buy it minus the premiums I received. Profit is completely straightforward. This is where it's the premium, number of contracts, and if you have a broker, like I was mentioning, that has a flat fee to start off with their per trade, you'd want to add that in here before the F3. And like if it was $9.99, oops, $9.99 plus that, and that would change your profit each time. But I don't pay that, so I don't list it, but that's where it go. And up here, you could also change the price per contract. That's roughly what it is for most contracts, most trades with Interactive Brokers, but it varies, depends on who it runs through for the trade. And let's see, going through here, K is now where we are. This is the percentage return based on total buy price if there's no strike, so it's essentially my return. And I'm basing that on what would my profit be, not annualized, just straight out profit after I receive the premium. Then I annualize it here, just taking the profit. That's where the number of weeks come into play. So say today is let's see, I said 6.9 weeks out. I would change to that, and you can see how it would change over here. And this is one of the most important ones, one of the most important cells in here, column M, because it shows how much it can drop, how much stock price or an ETF can drop when something turns against you. So it gives me how much cushion there is before I take a loss. M is if I sold it in the money, if I sold a naked put in the money, I want to see what the return is if it stayed flat. Doesn't really matter as much what their total return is if it stays flat, because I'm not getting the full premium. Some of that would be intrinsic value that wouldn't go away. So I really want to do a better comparison. Otherwise, if, say, Apple is trading at 114 and I was selling a 115 strike, my return would look pretty low there. But I put a logical test in here so that if the column C here, the current price, is less than column D, it'll use a different formula. So it kind of takes care of itself there. And let's see, going on to price equivalent. If I bought and held it, look at this sometimes just to see if I think, say on this one, when Apple's at 119 and I thought it might go up to 121 or 122, then I have a better chance of actually buying the stock instead of using an option on it or using this option. And it just shows me where I need to get the stock to be, if or how high it would have to go to make my trade not a good option put trade, but just a buy and hold, or even if I wanted to sell it in the money. All it does is take the current price plus the premium. Pretty straightforward. How much of a drop for a full gain? This is different than M, column M, because it's using the strike price as the basis. I want to see where it would have to go, not just so I don't have a loss, but if I wanted to get full profit. So obviously that's not going to be as low as if I don't deduct the premium. Q is just a holdback from when I was taking a lot more risk years ago when I first developed this spreadsheet. It takes the total gain and essentially multiplies it times 2. So I used to run on a 2-to-1 ratio, where for every $1,000 I had, I would risk 2,000. Now I don't do that because I'm older and smarter. But if you want to do it, you could change this up here in the formula up here. Change that if you're doing it on a 1.5 basis. You're risking 1,500 for every 1,000 you have, or anywhere in between. You could change that. Alright, so back over here, I told you I'd come back to the weekly theta as a percentage of the strike. So this is time value. This is showing just on a weekly basis, not that it's a linear decay of theta, of time value, but it is, just gives a little bit more of an apples to apples comparison on this one too. A lot of this is just all based on comparing option choices. So we'll see this as it comes down, but all I did was take the return and divide it out by, take the premium and divide the strike and the number of weeks that are in it and divide it out. So it just gives me a percentage to look at it. So I'm going to look at IWM, small cap ETF here. So first thing I like to do is get an idea on the chart of where it should be. This is the trading channel it's been in recently. It's starting to weaken every week. The highs are getting lower, the lows are getting lower. And this goes all the way back to December 9th when it peaked. And it's easing off since then. It's kind of a nice place now because it's on the lower end of the trading channel. Might be a good time to buy in. I think the low could find support either at the trading channel and come back up, although it might be stuck in there and continue to push lower. But maybe by the time it gets to the December 1st low, around 130-ish, 130.29 exactly, but around 130, I have a line there that shows me where it is. Also have an alert in there so that it sends me a signal if I'm not looking at IWM at that moment. So I think that 130 might be a fair price where it's going to find support, so I'll come back over to the option table here, looking at March, so I can kind of start flooding in some of my data here. It is trading at 134.15 right now, so I'm going to copy that down on all these, and I'm putting in multiple fields here because I want to do a comparison. I have 130, 131, 132. I'm doing it for the March expiration, which is 6.9 weeks out, and the April expiration, 11.9 weeks out. And I'll go ahead and leave it at 2. I had that in here for something else I was working on, but just seeing where it would fall. So coming back to that, if I have the 130 would be around 177, and 203 would be these two, 1.77, 2.03. 132 would be about 233 that I could get for it right now, and I'm only looking at going for the bid just to make it too quick for this illustration. 317, I'm on to April now, so not 317. The 130 would be about 2.94 maybe, or definitely could get that right now. 131 strike would be 3.25, and the 132 strike is around 159. You could probably get 360, but we'll say 359. So now I have all these bolded just so we could see them a little bit easier. It's a quick way to kind of look through and see. So first thing I'll do is I'm going to even highlight a little bit more here just to kind of look across. I want to look for at least a 10% return, which all of these are. And then I start looking at what my downside risk would be and how low, what is the cost of exercise, these in here. These are all below 130, so they're all pretty safe for what's likely to happen in the next couple of months based on my belief that 130 is going to be the floor down here. But coming down here, this is the that is the 100-day moving average. So, you know, maybe it'll come down there. That's a little safer bet. And for the returns on these small caps are pretty good. We don't have to take big risks. So, you know, for this, maybe I'd go for, I like to go 2 or 3 months out. If I can go 2 months or less, that's great because the time value decays a little bit quicker. That would give me 3 1/3% cushion before I had a loss, and it would take it down to 129.68. But if I went all the way out to April, if I go almost 4 months, almost 3 months out, that gives me over 5% protection. I still get a 10% return. So the decision on this would be based on if I'm trying to decide between these two, which are very different. They're a month different and $2 different on the strikes. If I'm trying to decide between these two, I'd really look at the rest of my portfolio and see how much cushion I had on everything else. If I had a lot more cushion everywhere, I'd take a little bit more risk, go for the 13.5% return here, which is the 32 strike. If everything was either at the money or close to the money, I might take a little less risk and go for the lower strike and more time, just so I can get a little bit more of a cushion from it. So that's basically how you use the spreadsheet. And let me know if you have any questions. Send me an email, comment below, and I'll see if I can help. Thanks, everybody.